Alright traders, happy Friday. It looks as if the Federal Reserve has officially cancelled Christmas and certainly the Santa Claus rally that the market was hoping to get at the end of the year. Now look, the dust certainly has not settled yet, markets globally on exactly what happened at that FOMC meeting this week. So let's just quickly recap the main points of that meeting and what's been moving these markets. So look, once a quarter, so only 4 times a year at these FOMC meetings, the Federal Reserve releases its dot plots. So these are basically the expectations of the Fed members of where they expect interest rates to be in the following year. Now those Fed members, the average of those dot plots had their expectations of the Fed funds rate to be at around about 3.9% in 2025. Now they did cut rates by 25 basis points down to 4.25%. So if the Fed members only expect the Fed funds rate to go down to 3.9%, that only means that they are pricing in potentially 35 basis points of cuts next year. So that only really guarantees, or the Fed members are on agreement on just one rate cut, and a second rate cut is something that is less than a 50% chance from the way that the Fed members have arranged their dot plots. So market was expecting a minimum of 2 rate cuts next year in 2025 and potentially 3. So the Fed dot plots was certainly a huge surprise, very hawkish. And it was basically the Fed communicating to the market that they are pretty much almost done cutting. And they certainly will not be active next year, and the bar has been set very high for the Fed to actually cut next year. So that's literally what has surprised the markets and has moved global markets in a big way. Look, the market that obviously moved and is one of the more meaningful markets is the bond market. US 2 yields, 10 yields, they both spiked up about 15 to 20 basis points. We have got US 10-year yields now trading as high as 4.6%. The highs for the year aren't too far away. It's around about that 4.7+% there. Now, bond yields are not supposed to be going down when you have a central bank that has been easing and cutting rates. But since the Fed started cutting rates, we've seen a sharp rally in US bond yields. That has been one of the main drivers of obviously this US dollar strength that we're seeing in the markets. The US dollar is an absolute wrecking ball at the moment. Dollar index, now is trading up past multi-year highs above 108. We did have the dollar index trade in a extended range for the last few years, from 100 up to 106. It has broken that range now. Technically, generally, when you break a range, just the width of that range is the initial minimum target you're looking at. So if we're range trading from 100, 106, it's about 6 big figures. So potentially dollar index up to 112. We're at 108 at the moment, which basically says that, technically, we still have a lot of room left for this dollar rally. So look, it's a theme that we've been talking about on these updates quite often, that about this US dollar strength, and it's something that certainly you do not want to be trading against. If you have been trading, selling US dollars, certainly that has not worked for you. So I'd suggest that this trend is a very aggressive trend, and stick to the long side of basically trading US dollar. Obviously, equities didn't enjoy what happened with the Fed. They love rate cuts. They want to see the Fed still in the game next year. It has been something that has been supporting markets. So obviously, we've seen S&P down about 250 points from record highs, and NASDAQ down 1,000. And I would say that we have seen a meaningful top in those equity markets. At least in the short term, potentially medium term. So. Potentially strategy now in equity space, selling rallies. The other quick takeaway from the Fed meeting is when Powell was asked about Bitcoin and whether or not the Fed would ever be buying Bitcoin, because there's been a lot of speculation potentially with the new Trump administration that there might be a US Bitcoin reserve. And Powell certainly answered that very clearly and said that on their charter they are not allowed to buy Bitcoin, and they were not looking to change the laws of their charter. So in essence, they put that speculation to bed. And it was one of the things that had Bitcoin bullish, and reaching those highs above 100,000. So I'd say potentially we've seen a significant high in Bitcoin as well at those record highs of 107. I'd imagine there is a lot of sellers now above 100,000, and certainly I think the strategy there now is selling those sort of levels. Moving along, yesterday was another important day. Central bank meeting wise, had the Bank of Japan meet yesterday. There was some speculation that potentially they could surprise hike yesterday, especially with the Fed being so hawkish and putting a lot of pressure on the yen. The Bank of Japan came out and there was no change in rates there, so they left their policy rate at 0.25%. Now, the Bank of Japan will be hiking at some stage in the new year. Market was looking at potentially now January, but in the press conference, the BOJ governor said that not sure whether or not January is the right time, that potentially they want to see more data. So it looks as if maybe the Bank of Japan's first rate hike next year will be pushed back to March, when the Bank of Japan gets a bit more data. So what did that mean for dollar yen? Well, obviously that was not good for the yen. It was great for the US dollar. And we've seen a fantastic rally in dollar yen, back up towards 108, so almost 400 points since the Fed meeting. And I would say, just with the way that the Bank of Japan meeting went yesterday, it has certainly given the market a green light that there's no short-term rate hikes by the Bank of Japan early next year. To continue buying dollar yen. I'd say that those 40-year highs in dollar yen, 160 plus, certainly the market's target, and would not be surprised if we do break above those levels now. So stay long dollar yen. It looks like it's almost a free trade. Moving along today, yes, it is Friday, but we still have an important risk event. We've got some top-tier US economic data. We have got PCE inflation data, which is the Fed's preferred inflation guide, and the market is expecting there for the PCE data to go up marginally from the previous month, from 2.8 to 2.9%. Now, obviously, post the FOMC meeting and the fact that the Fed doesn't want to cut rates anymore, if we do see that PCE data coming as expected, which is marginally higher or even above expectations, it's probably the last thing that this market needs on a Friday before the weekend, and especially after the wild volatility and carnage that we've seen in the last couple of days, that potentially we'll see bond yields tick up again, stronger dollar, and equities sold aggressively. So certainly, if you are still trading, tonight is still a very important night with US PCE data. Anyway, good luck with it all, and we'll check back in next week.